My guest today is Johannes Hock. Johannes left private equity early in his career with the aim to build wealth faster through an exit after buying a business. In 2022, he bought DFW Turf and he quickly grew the business from 5 million to 20 million in revenue. This through organic growth and additional acquisitions. He sees a path within a few years to 50 million revenue and healthy EBITDA before an exit. Thanks a lot for coming to the podcast, Johannes.
Thanks for having me, Mick.
You have a background in finance and private equity, as a lot of the listeners. So please give an overview of where it all started, all the way from university. I know now that you were a very good athlete.
So I'm from Germany originally. Came to the US via running track. I was a decathlete at the University of Texas. Kind of fell in love with the US, with the land of opportunity. Graduated here. Kind of had to take a little bit of a detour to get into the finance world. I was very focused on track in undergrad. Did a degree in kinesiology there. Eventually decided to pivot. Did a master of finance, and then had to play a little bit of catch up. So started my career in accounting in Europe for a year and a half, then made my way into banking and eventually private equity over the next couple of years. And then in 2021, my business partner and I decided to kind of go out on our own, look for a business to buy, and we're pretty went pretty quickly. Found DFW Turf, which is an artificial turf install business. Liked a lot of the characteristics, and bought that business in 2022. And we're now in year three. Business has grown a lot. We're now in 7 cities. Expanded it significantly, both via opening new locations and acquiring other installers. And looking to build it into a national install platform and eventually exit it.
Okay, let's go a few steps back. You and your co-founder, how were the conversations like? It's always awesome when you find someone who's willing to quit their job and go buy a business, grow a business, and eventually sell it. In theory, but in real life, it's very hard because quitting your job, not getting paid anymore. How were the conversations, and how was the decision making behind that?
Yeah, absolutely. I mean, to this day, I say it's the best decision I've ever made to partner up with Bennett. I think we were looking at the opportunities ahead of us and the opportunity in the market very similar. So at the point in time, we're both associates at a private equity firm in Austin, and you get kind of 2 years into private equity, and you have a little bit of a decision to make of, am I going to do this for the next 20 years or so, or am I going to jump off? That's usually the time that people think about getting an MBA. And we both looked at the opportunity and said, why don't we take this 2 years, see if we can find a really good deal that gives us a lot of the economics. I don't know how familiar your listeners are with the self-funded search model. I know you had Bruce Marks on recently, who was pretty instrumental for us as well in getting a deal done. But you end up with pretty much 4 times the amount of carry that you would in a normal deal. It's a high risk, high reward type of playbook. But if you get one right, you can really knock it out of the park. And for us, that just was the right kind of opportunity. Is very attractive to us to have a chance of hitting a home run while you're young. If you're wrong, sure, you lose a couple of years, but to me, the difference between retiring at 55 or 50 is pretty irrelevant. When in the traditional private equity career, you pretty much lose your whole lifetime from 20 to 50. And so on the flip side, with the self-funded search model and buying a small business, growing it large, taking a big risk, the potential of being done at 35 and kind of hitting never have to work again money was pretty attractive. And we kind of viewed the world in a similar way. We'd seen a lot of businesses in various industries that had gone down the same path. And frankly, we had invested in a lot of owner and operator, family founded businesses that had built a great business and had built great wealth. But to me, and to us, they hadn't done anything insanely difficult in terms of, intellectually, it wasn't all patented and super novel processes. A lot of it was just doing the right thing over and over again for 5 to 10 years. And so that seemed like a challenge that was doable if we found the right business. And that's what DFW Turf ended up being.
Many private equity professionals stick to their career path, like chasing carry and stability. What do you think separates those who leave to buy the business from those who stay in for the long haul?
Yeah, I mean, I think it's two things. One is you have to have a certain risk appetite, right? The path, especially that we chose, and I want to separate that a little bit from kind of an independent sponsor career, which is very similar to a private equity career. In both, you need to have several wins over a long time to become wealthy and to be really successful. If you as an associate, as a VP in a private equity firm, if you want to strike out on your own, you're pretty much stuck with an independent sponsor model that doesn't give you a lot of carry in the first couple of deals, that you have to buy pretty small at, and it's probably going to take you a decade to get to a meaningful carry check. Anyways. And similar, if you stay in private equity, it's 10 years of working your way up to become an MD, 10 years of being an MD in someone else's fund and making money for them, and then you got to do another 10 years of being successful to really make money for you. And so I think the game has changed where, 20, 30 years ago, I think a lot of people that get into private equity have read the, Barbarians at the Gate and the Predator's Ball and the kind of old school corporate raiders in the 80s, 90s, where as a 30-year-old, you got a real piece of the pie and you could make life-changing money at that stage of your career. That doesn't happen anymore today in the vast majority of cases. And so I think the people that make the jump are the ones that realize that and then are willing to take higher risk for the short term to gain meaningful upside, versus if you're I wouldn't do this with family and kids and a lot of dependents and a lot of bills. I think it's really, you have this short window of opportunity, kind of 25 to 30, when you're in that career where you can make a jump, take a lot of risk, and if it pays off, you kind of step off the treadmill.
You've mentioned that risk tolerance played a big role in your decision. Looking back, do you think you underestimated or overestimated the actual risk of acquiring this business and making this decision?
I would say probably about fair in terms of like the actual risk. I think in terms of the perceived risk and the roller coaster that it is to actually sign a personal guarantee and live with it day to day, I would definitely say underestimate it. I think it's very different when you're coming from a career where you have you're 2 or 3 layers removed from the actual operation, right? You have yourself, then you have a CEO, then maybe a middle management, and then it's the folks doing the actual work. There's a lot of noise and a lot of volatility that gets filtered, right? You get high level KPIs, you get high level financials. You don't really know how much it takes to actually get those financials on paper, right? Like, receivables don't collect themselves. Stuff goes wrong all day, every day. And if you're several layers removed from the actual operation, you don't notice it, you don't hear about it, right? It's a little bit how in the valuations for private equity firms and private credit funds, somehow the marks always stay the same despite the public markets going up and down. So it's a little bit like that. And so I think in terms of the actual risk, probably fairly evaluated, but you feel the volatility on a day-to-day basis. You have one day where you have a couple big sales and you're excited beyond measure, and then the next day the truck breaks down, two guys don't show up, and a customer is pissed off, and you think, what did I get myself into? So I think emotionally it is definitely underestimated, but I think on the true risk side, probably about fair.
Where were you financially, if you can share, when you quit the BE job?
Yeah, I mean, I think we both had kind of set aside 2 years of living expenses to find the business and take the risk, and I think it was very clear that the majority of our money, or the money we had to set aside, was going to go into the business, especially with signing a personal guarantee. You're effectively all in. I think in general this path becomes a lot harder once you're starting to have several hundred grand, million, 2 million, 3 million bucks in the bank account, or as net worth, right? Nobody's going to just have it sit in the bank account, but the trade that we made with the SBA like route is effectively downside is zero, upside is you make a couple million bucks. When the less you have to your name, the better of a trade that is, right? If you already have five and you stand to gain five, that's probably not a good trade. So that's why I always talk about kind of 25 to 30 is probably about the sweet spot to do this.
Okay, now the first deal. How did you find it? How many frogs did you kiss? And how was it all?
So we started kind of September 2021, focused on just broker deals. I think it's always best to see what's on the market first. Those are the most actionable deals. Obviously, proprietary, you can sometimes find a really attractive deal, but it also takes really long. I knew for myself that I'm not a very patient person and I need to see progress. I was rather going to have a minus business, but get into it really quickly, then wait 2 years to find the perfect one. And so focusing on broker deals was the path to get there faster. I think we certainly looked at several hundred deals over the matter of 2 or 3 months. We ended up submitting I don't remember the exact number, but probably close to 50 IOIs. Signed, probably submitted over 10 LOIs, signed three, and eventually closed one deal. So I think those numbers are pretty similar to what you see in most search deals. It's absolutely a volume game. I think what stood out for us was we just did it in a lot faster time frame. We signed the LOI for the deal we eventually bought 6 weeks into really searching. There's certainly a lot of luck involved there as well, but I think the lesson that other searchers can learn from it is just focus on volume, right? Whether you do the look at several hundred companies over a matter of 3 months or 2 years doesn't matter. It just you have to get through the volume of potential deals to find the one that's right.
What is your thought process behind like chasing this perfect deal versus or perfect business, if we can say that, compared to just getting something done and just getting into the game?
Yeah, I mean, I think there's two sides or two reasons why I think speed matters a lot. I think one, with the multiples you typically pay, right? Most of these businesses trade about 3 to 4 times, especially with the SBA process. You're really capped at about 4.5 times. The bank's not going to approve more. And the debt service won't support more. And in the whole structure that you're looking for, you're not really able to pay more. And so cash flow really matters in these businesses, right? If I get 6 extra months of cash flow, that's half a turn of EBITDA, right? And so my thought process was, as a searcher, it's a little bit different as an investor, but as a searcher, buying something for 4.5 times today is effectively the same as buying for 3.5 times next year. And so, given that you pretty much run through your entire valuation range within a year, like finding a pretty good business early at a good price is really hard to beat later on. And then what compounds on top of that is you're just going to get fatigued, right? It's going to be really hard to keep striking out. Your cash balance and your bank account is starting to dwindle down every month. Like it is, searching is emotionally very taxing. And so it's much easier to make mistakes later on, when you're 2 years in. You're like, man, this deal is kind of looking good enough, and you're much more likely to make mistakes. So that's why we were so focused on let's create as much of a feeling of abundance as we can by having a ton of different deals in the hopper. It doesn't feel like we have to have this one certain deal. Let's pay up for the deals that we really like and just get in the seat. Because with these deals, right, like in a typical private equity world, if you're paying high single digits multiples, if you're paying low double, even mid double digit multiples, you're like an extra 20% of purchase price is everything, right? If you're paying 18 times instead of 12 times, you're not going to make that up. Like that's going to be a problem. If you're paying 4.5 instead of 4, it might be the same percentage, but you can easily make that up, right, by just operating, holding it a little bit longer, all that kind of stuff. And so I think over focusing on price is not the right strategy when it comes to search deals. You just got to find a business that's good for you and get in the seat and start working your ass off.
You mentioned Bruce Marks, the famous SBA lender. How was the whole process? I'm asking because he was just on the podcast and I saw his views. So how are your views and what did you have to prove to him to get him to commit?
Yeah, so I think what was kind of unique about our deal was the fast growth of the company. The company had been rapidly growing historically to the point where we looked at that deal in October of 2021. The business was more than 50% larger, or on track to be 50% larger in 2021 than it was in 2020. And the typical underwriting of SBA lenders is based on historical tax returns. And so, the price that we were going to pay wasn't going to work based off of 2020 tax returns, certainly not 2019 tax returns. And so we needed a lender that was willing to not just look at the straight box and say, well, we look at the last 3 years on average, and every business is the same, and so we're not willing to look at the actual story and the unique circumstances. And this is where Bruce came in. I think he's one of the most commercial minded lenders out there that is willing to actually look at the business and, hey, does this make sense to me as a lender? And so we were able to tell him the story and explain why we thought this wasn't a one-time blip, why there's true long underlying tailwinds in turf, and Dallas, the market that we're in, the population growth. Generally, the generational shift from boomers more to millennials in terms of home ownership and their preferences. And so he, agreed with our view that there was, a long-term underlying demand curve that was rising quickly, that this business was well positioned to benefit from. And so the deal that we came up with was we were going to do the underwriting based off of a QOV for the last 12 months of October, and then close the deal once the 2021 tax returns were in. And what that helped us do was shorten the closing timeline by 2 months. If we had to wait until the 2021 tax returns were filed and then do the deal, it would have been 6, 7, 8 months of kind of that deal being in limbo. It probably would have fallen apart. Time kills all deals. It doesn't help the credibility of the buyer if the deal's just kind of sitting out there. And so that's what he helped us do, was just to kind of go through the underwriting process, make progress towards closing the deal. And so we had the approval, we were ready to go. And so once we hit 2022, beginning of the year, it was just a check the box, get us the tax return. The numbers came in where they were supposed to come in, and we were able to close the deal and start running.
You've said before that recurring revenue is overrated, and when you look at those businesses that people are chasing, they're after recurring revenue, sticky customers, this moat. So what other conventional wisdom in search fund acquisitions do you think is like maybe misleading or flat out wrong, or why is your opinion as it is?
Yeah, so I think it comes down to how do you create equity value over the whole period that you have, right? And there's various different ways that you're going to do it. There's obviously the ongoing cash that the business is going to generate. There's the organic growth you have. There's potential multiple expansion, all those different versions. And what I think is tricky with recurring revenue business is just the growth side. A lot of times the reason, if your customers are really sticky, your competitors' customers are really sticky. A lot of these times, these are kind of mature markets, and you end up with a situation where you're able to improve things around the edges a little bit, maybe professionalize things a little bit, but then you're kind of stuck at, okay, you grew revenue 5%, and now that's just where the business is, right? And then you gotta look at more acquisitions to grow further. And if you did the first acquisition with an SBA deal, that becomes tricky really quickly. You're gonna tap out of capital you can raise. And so then you're kind of stuck in this limbo of like, yeah, this is a nice business where it generates some money, but you're not going to have the kind of slam dunk home run type outcome. And so I think that was the part on recurring revenue. And in general, I think when people look at these businesses, they think everything's kind of the same, right? They're kind of willing to pay the same multiples. These businesses all kind of look similar, and I disagree with that. I think the span in quality and opportunity in these businesses is incredibly wide. There's incredibly bad businesses, and then there's incredibly good businesses. But you can't just look at high level financials. Like you have to, kind of build the muscle, and that's where the private equity background helps of seeing a large variety of businesses and, where the opportunity in different businesses lie. And so, for us, the example with Turf is you have a business that not only has the option to grow geographically, but you have a massive growth in the underlying market. So, you don't have to do anything. We're going to talk about growth in a little bit, I think, but like in general, we looked at the underlying adoption of turf is going to carry this business alone. The market that we're in today is growing a lot, and we can do geographic expansion, right? So that was a business that probably deserved a growth multiple, but because it's in that SBA size range, it's still going to trade at the 3-4 times multiple. And so I think people are focused on finding something that neatly fits the box, and I don't think that that's where the real home runs lie. So you got to find stuff that you actually have to look at. What does the business do, what drives this business, and not just what's my number for customer concentration, what's my number for recurring revenue, what's my you're not going to find the opportunity in just the numbers. You have to actually understand what the business does and where it could go.
So let's talk about post-acquisition. First 30, 60, 90 days. What did you take from private equity and what did you right away implement it?
Yeah, I think the number one thing is cash controls, right? In general, cash is king, and that's something that people very easily forget. You can't eat revenue. You can't just assume that your receivables are going to get collected. You can't just assume that nobody's using the credit card for something stupid. Like that is your job as the operator. First and foremost, make sure cash is coming in the door and there's money in the bank account, and that balance goes up over time. And I think that's what we took in and brought in. That was our main focus in the beginning. Was just let's make sure that all the cash comes and goes into this box, and we know what goes in and what goes out, and make sure that we put more in than goes out. And then it's kind of make sure you never know the business as well as you should through regular diligence, right? So the first 3 months or so, 3 to 6 months is the time where you're going to discover all the things that you wish you would have known about. And so the faster you can discover bad surprises, the better, right? If you just close your eyes to it and just try to focus on the things that you enjoy working on, that's going to come back and bite you, and it's only going to become a bigger problem. So coming in and truly understanding what does everybody do, what's going well, what are we not doing well, and truly understanding how the business works was the main focus. And I think that's what everyone should do, right? It's that the first 3 to 6 months is just cash controls and truly understanding the business. And then you can start working on improving the business.
So what about your strengths and weaknesses compared to your co-founder? One thing was to get this deal over the line to close it. What about now, post-acquisition? What are your focus on and what is he focused on?
Yeah, I think we have a pretty unique partnership in the sense that, we come from a very similar background. We think about the business very similarly. So we almost run it completely interchangeable, where we have our hands in both, or in all activity, both our hands in all activities. It's almost like there's a list of things to do, and whenever you complete one task, you take the next task off the list and you just work on it, and versa. I think it works because our skill sets are so interchangeable. Um, but I think generally it's helpful to have clearly defined responsibilities for a lot of people. I think this is a unique model that kind of works for us. I don't think that's something I would recommend to everybody. It requires a lot of flexibility and just being willing to do whatever it takes next, right? But that's kind of how we run it, and it's worked well for us. But again, I think it takes both people being just willing to put your head down and get the work done, and not being like, well, this is my project, this is your project, this is my domain expertise, this is your domain expertise. So it's a very unique collaboration.
When it comes to the team, how many people left? Who stayed? Were there any changes post-acquisition?
Yeah, so essentially everybody stayed. I think we had one admin that was hired, 2-3 weeks before we got there, that ended up not being a good fit. But everyone that had worked with the company for a long time stayed on. I think a big part of that was having a general manager, and he continued to run the operations, the same way they were before. And we just, we see our job in general as supporting everyone and making their job easier, and helping them be better at their job, rather than telling them how to do their job. And so I think the transition was very smooth in that regard, which helped a lot with stability and retention.
The fact that a strong general manager continued, how critical you think that was in your ability to scale the business?
Very critical. I think it's something that I didn't place enough value into going into the search. I think I considered it a nice to have, rather than a must have going into it. I think what it enables you is to work on growing and improving the business much faster than otherwise. I have a lot of friends and colleagues that also bought a business around the same time, and by necessity, they had to spend the first year just becoming the GM, learning how to be the GM, right? And so you're working in the business by day, and then with whatever energy you got left at the end of the day, you're trying to make some changes. And I think that's, you can't exclude businesses that don't have a GM. I don't think that is as common at the size that we're looking at. But I think I would absolutely place a premium on a business that has a good operator in place that you can work with.
And now looking back this 90-day period, is there anything you would have done differently, or it was all good and it is still all good?
I definitely would have put more cash on the balance sheet. So we, I think we structured a very tight deal. We absolutely maximized equity by keeping the overall, uses and capital needed very low. Then you have a little bit of an overrun on legal costs here or there, and all of a sudden our cash balance that we expected to have going into the business was quite a bit lower than expected. And frankly, the way that it works with SBA deals, it wouldn't have cost us much extra to have an extra 100, 200, 300 grand on the balance sheet. And so we took over the business, and the first 2 weeks was just kind of cold freezing. We couldn't do any installs, and so you're sitting there, and the interest is ticking up, and payroll is accruing, and there's no work being done, no revenue coming in the door. So that's pretty stressful, and we could have obviously mitigated that by just having a little bit of reserves, a little bit more cash on the balance sheet. So I think operationally, I wouldn't have done anything differently, but I think structuring wise, we definitely could have made that a little bit less stressful for us.
You said you really squeezed this deal when it comes to equity. I didn't ask before, how is the structure, if you can say? It's just you and your co-founder, or how many more people, investors are involved?
Yeah, so we brought investors in for the majority of the equity deal. So for those who aren't familiar with it, the equity in self-funded search deals is priced on a step up. So what that means is typical step up is 2x. So if you're raising 10% of the overall deal cost, so let's say it's a $5 million deal, you raise $500,000, that would be 10% of the deal costs. You're going to have to give those investors 20% of the equity. If you're raising, let's say 15%, you're going to have to give them 30% of the equity. And so that's how you can end up with significantly higher upside than in a traditional deal, right? So let's say you're able to structure a deal where you can bring the equity down to, let's say, all the way down to 7.5% going in. You as the searcher would retain 85% of the economics versus, in a normal private equity independent sponsor deal, you get 20% of the upside. So that's where that unique opportunity comes from, and obviously it's particular to the U.S. The SBA program only exists here, but generally that's the unique opportunity. And so our deal was similar to that. We gave investors a 2x and retained the majority of the equity. But we're lucky that with our fundraising and how broadly we went out, we were able to find a lot of investors that didn't just write a check, but actually had experience either as a searcher, related to sales and marketing, related to home services, related to the Dallas-Fort Worth metro area that we could lean on, especially in the first year or so, to make improvements in the business and make the deal a success.
What is your thought process when you think of just taking just the money, let's call it like dumb money, versus taking this money who you took it from, like people who with real experience and who could really add value?
Yeah, I think, I mentioned that the partnership was probably the best decision. I think paying up to get better investors was probably the second best decision I've made in regards to this deal. I think it can be very easy to think, hey, the extra like 2, 3, 4, 5% of equity is real money, right? And that's money that I could retain. I think especially as a first time buyer, there's a lot of things you don't know. And there's a lot of things that someone with a little bit of experience and good investors can protect you from. And so the way I would think about it is just really cheap insurance on the downside. So for example, I've had plenty of deals reach out to me since then where they did take the dumb money, and I've had one or two of those that went bankrupt because they made mistakes that any experienced investor would have caught. One of them was a default confession of judgment in a seller note where the deal went bankrupt over 1 month of unpaid seller note interest, and the seller just decided to be irrational, blow up the whole deal. And so it's little things like that. It's little, and just having a good sounding board if you're making decisions. So, for example, we had a good sales and marketing guy on our cap table, and so when we were like, "Hey, I think this website's archaic, we should change it," and he would look at it and say, "Actually, you're ranking well. You don't know why you're ranking well yet. That's a bad idea. The upside downside isn't a good trade here." And so it's a lot of those factors that I think it's cheap insurance on the downside, and then similar on the upside. You want smart people to kind of be a sounding board and a check on you. So if I bring a deal like an add-on to our investors, I want them to actually be critically think through it, right? I don't want a bunch of yes men on my cap table. Because you end up making better decisions if you have smart people and experienced people challenging you on big strategic decisions and being able to get their advice as well. And so I think on average, I would happily make the bet that folks that pay up to get better investors end up making more money in their deal, even though they have a little bit less equity, because the overall outcome is so much better.
So you bought the business in 2022. You did your first add-on on early 2024. So before the add-on, it was all organic growth. But you also mentioned that in the first 60, 90 days, you couldn't really generate revenue because it was cold outside. So what happened after that? How were you able to grow the business so well? And what did you do pretty much to achieve that growth?
Yeah, so I think the cold happens every February. We lose about a week or two to installs in Dallas, so that's nothing out of the ordinary. It was just one thing that we should have structured for better in terms of the going in cash rate, but wasn't a big deal at the end of the day. I think when you look at the trajectory of the business, it just continued on the path that it was already on. And so, when we looked at the industry and this business in general, artificial turf for recreational use, so backyards, playgrounds, had been around for about 20 years, but really only on the West Coast. So California, Nevada, Arizona, and it had made its way to Texas about 10 years before before we bought it, 8 to 10 years. And so what you could see was just the adoption over time. This wasn't something where it was a one-time COVID bump. It was something where people were getting familiar with the product turf. Most customers that we talked to still, that was the first time they had seen non-sports field turf. And so there was a real adoption trend there for homeowner where this is a product that is a really good fit for homeowners in Texas. And then, consequently, it's starting to become a really good fit for homeowners all across the U.S. With, the weather we have, with the watering restrictions a lot of folks experience. And so we just made the bet that, hey, in 10, 15 years, Texas is going to look like an Arizona or Nevada when it comes to turf in recreational backyards. And when we bought the business, it was probably less than 1 in 100 homes in Dallas had turf. And if you looked on the West Coast, it was somewhere between 20 to 40. And so you didn't have to make this bet that it's going to be 40 and you're sitting at 20, you're sitting at 35. If we even got to 5 in 100, you had a home run, right? And so that actually was probably one of the big drivers that played out. Turf just continued to become more and more popular over the next in 22, 23, 24. Dallas as a city continued to grow, right? Lower cost of living compared to the coast, great job opportunities, a very kind of healthy middle class that has good jobs, disposable income, can afford a product like that. And so a lot of it was just the bet that we made playing out. So that's kind of underlying market growth. At the same time, we did everything we could to take market share. So making sure we were not visible in certain areas in Dallas. Expanded the website, professionalized a lot of the lead channels, and so just kind of gained share on that side. And then, kind of 23 was the first new market that we opened when we opened a location in Austin, which is about 4 hours from Dallas. So kind of started the blueprint of like, okay, this isn't just a Dallas story. This is really a kind of Southern U.S. story. And, let's just bring that blueprint we developed in Dallas to other markets and start installing there as well.
When we take the employee count and the growth, when you take like post-acquisition till the first add-on, like how many new people did you hire?
I think we hired about 30 or so. We do most of our installations on a subcontracted basis, so the actual installers are company employees. So the absolute number of people in our operation is a lot bigger, but on the employee side, it's about that.
Not too many buyers want to acquire those high growth businesses, and they prefer maybe more stable businesses. What are maybe some of the risks of buying business that's growing 40-50% per year? What have you seen and what have you been going through?
Yeah, I mean, I think the massive risk is that typically if it's that easy to grow, it's also equally easy to shrink. Around the time we bought, there was a lot of businesses that if I just gave you the financials and didn't tell you anything else, looked exactly the same as our business. And there was a lot of fear around COVID bumps, right? Everyone was cooped up inside. Everyone were like a great example is the pool business, which is very adjacent to us. And they had their best years ever in kind of 2021, 2022, and then started having really tough years and things came back down to earth in 2023, 2024. And so you got to be very careful with growth and especially buying off of kind of the peak number of the best year that a company has ever had, that you're not catching a falling knife. And it turns out that the seller they will forget more about the business than you will ever know about the business. And so they might say, hey, I've had the best year I've ever had. I've just made 3 times as much money as I've ever made. Let me sell off of that number because the money I can make in the sell is more than I can in 10 normal years, right? if you buy that kind of business, you're screwed, right? Like you cannot afford to buy off of that number. And so I think people are rightfully skeptical of businesses that are growing really quickly, and you have to be able to prove out why that growth is going to continue, and the business is going to continue to perform at least that level. And so I think there's plenty of people that looked at our business and said, I don't think that this is an adoption story. I do think this is just a one-time COVID story. And again, I think this falls into the category of like, are you focused on the box? Are you not willing to stray outside, even if there is opportunity? You're going to be safer in the box, but you're also not going to have the home run. And so I think that's a little bit of like what makes a good investor and a good searcher to a certain degree is being able to distinguish those two. And you're not going to be perfect at it, right? Like I don't think you'll ever have enough data to be 100% certain. There wouldn't be the returns and the potential in it if there was that level of certainty in it. But I think that's where the nuance is, and so I think it's absolutely correct for people to be skeptical if a business is just skyrocketing. But there is, for every 5 businesses that this is going to be the peak year, there's also a couple that it's a trend and it's going to continue.
You quickly reinvested in growth, buying more trucks, expanding capacity, and hiring aggressively. How do you balance reinvestment versus being profitable?
Yeah, so I think a lot of that comes with the business model itself, right? We operate very asset light. I mentioned the subcontractor crews. So if I bring on another crew, I don't have to buy the truck and the trailer and all the equipment. And so the investment for us is we've always been able to just fund all the growth out of cash flows, and that was by intention when we looked at the business, right? We said it's not going to take millions of dollars here to grow the business aggressively, and I think that's why a lot of people are focused on asset light businesses, where if you need to buy a $1 million kind of maybe a hauling truck or a tow truck for something, or your typical technician needs a $1 million, $2 million investment, it's a lot harder to scale.
You achieved the great organic growth, but still in 2024 you decided to make the add-on acquisition. Could you share what was the structure? How did you find this business, and how was the whole process, and maybe synergies and implementing this, and how was it all?
Yeah, so I think the way that what we learned in the first 2 years was effectively that we were coming in and thinking that this was a Texas story, right? There was going to be adoption of artificial turf in Texas. We were always going to go to Austin and Houston, very similar markets to Dallas, same state, just makes a lot of things easier. And what we learned in the first 2 years was just that this wasn't just a Texas story. This was a whole Southern U.S. story. And so then it became a question of, well, how do we attack and go into all these other markets? And I think to me, finding a good business in any given market that we want to be in, that has a local track record, has a certain size, is just a shortcut. Like we could probably get there over 5, 6, 7, 8, 10 years, but I would rather start at $1 million of EBITDA and grow it to 2 than start at 0 and grow it to 1. Right? Obviously you have to buy the right business, but so we started looking, all kind of nationwide at businesses that fit that mold, and continue to look for that. Anyone in the turf space that's kind of 5 crews, 3 to 5 million revenue plus is a good acquisition target for us. And we have a track record now of buying those, improving those, and helping them grow, and helping the operators kind of focus more on what they like to do. Right, a lot of owner operators like to focus on maybe the sales side, on the install side. They hate the back office side, and maybe the marketing and website and accounting and all that stuff. And so we have a platform now where we can take the tasks that they don't like off their hands and just let them focus on the ones that do like. And so that's the acquisition side. And then there's plenty of markets where those players don't exist, or they're not interested in selling, which are all fine. And those are the markets that we then open new locations in.
When doing add-on acquisitions, do you buy 100% of the business, or majority or minority? How does it work?
Yeah, so we're pretty flexible. It's anywhere from 51 to 100%. The thought process there is really kind of being flexible around what the owners are trying to accomplish, right? If you're an 82-year-old owner and you're like, I just want to sell 100% of it. I'm not interested in getting a part of the overall platform and eventually selling with the overall platform. That's totally fine. We can take 100%. I think our preferred option is someone who's built the business to a certain scale and just needs help kind of getting from, let's say, 5 million or 10 revenue to 10, right? Where you need to have some more support on the admin side. Maybe they are still handling everything, and they say, "Hey, I've built a great business. I want to take some chips off the table. I want to have a big payday, but I still believe in the opportunity of this business, and I want to continue to run it, grow alongside with it." And so I think those situations where they roll, 20 to 40% of the sale price into the overall company is a preferred option. And I think we need the majority in order to kind of consolidate financials. Like, it's just building an integrated platform, right? We have a couple tech systems that we want to share across all locations. Our field service management system, accounting system, phone system, stuff like that. So that way we can actually leverage our capabilities across different locations and different brands. But other than that, we really want to maintain the local operation, right? They become successful for a reason. It's a brand that's known locally. They do, there's different things that you do slightly different. And so we want to maintain all that. And that's why we have this kind of wide range of flexibility on how to do these acquisitions.
Have you done just one, or has there been many more?
So far it's been the one that we've done. We're working actively on a lot of other ones. I mean, generally we run the business very lean. I think we could go more aggressively. I'm a firm believer in not overpaying. That doesn't mean we're trying to just lowball things. I think it's about paying a fair price for the right type of assets, and then also staying focused, right? I think we have so much opportunity with new markets as well that unless there is a good deal that makes sense for us, we're not just going to do deals just to do deals and show a bigger revenue number. I think there's, on a day-to-day basis, we can work on new locations, and that's incredibly accretive to the company and to the growth. And so it's more kind of opportunistically. We certainly want to acquire more, but it has to be the right fit. This isn't just a roll up where, hey, we have to buy 5 deals a year just to make the numbers work.
And how are you funding these acquisitions? Are you using, again, SBA loan, Bruce Marks, or seller financing, or adding additional outside investors, or simply the cash flow from the initial business?
Yeah, so we were lucky with the growth that we achieved, that we kind of were able to graduate into the next level of financing. When we did the first acquisition, we partnered with a family office out of New York that financed the initial acquisition and gave us additional kind of an additional line of credit for future acquisitions. And so that's going to enable us to move a lot faster, right? SBA loans are great in terms of the amount of leverage you can get, but there is a lot of paperwork and bureaucracy involved in it because it's a government-backed program. There's just, that's just the pill you have to swallow with it. And so the new partner that we have there is we're able to close deals a lot faster. We can do them consecutively. And so that's the main funding source there.
You mentioned the family office from New York City. What are the numbers? What I mean is, how many did you talk to, just to understand like how easy or hard it is to find a partner like this?
Yeah, so we did, kind of went through some of the financing platforms and just said, hey, here's kind of a teaser of who we are, our financials, what we're looking for. And so we ran a small process and probably talked to 10, 15 parties or so. I think generally, especially in the US, there's a lot of demand for this type of investment. So there's certainly 50 to 100 funds and family offices at least that focus on these types of investments, kind of minority minority investments in a kind of debt equity type scenario for anywhere two to 10 million of EBITDA type of range. And so it's as long as the underlying business performs well and there's a good story for why there will be future growth. There's a good amount of demand for this type of financing in the market.
You mentioned keeping a lean team. As you plan to add more companies to under the holdco, how are you thinking about management and leadership, and what are maybe some of the new positions you have to create or people you have to hire?
Yeah, so I think we focus on the local operations being run locally. So every company is going to have a local general manager that really kind of runs that location. And then we've already built out kind of a shared service center at the corporate level. That is focusing on accounting and call center and all those factors. And so I think there will be some roles here or there. I think right now Ben and I are still, doing a lot of the executive work. At some point, maybe we'll add some folks at that level as well. But I think the whole goal of the investments we've made in the last year or two was to create a system that can slot in other companies and other locations and use the same processes that we have and add more of the same roles instead of having to add new roles. So there'll maybe be a new role here or there on kind of the corporate level, but we've spent a lot of time and invested a lot in building a platform now that can scale way beyond the size that we're today.
When listening to your story, it's like, okay, it's not easy, but it's obviously doable. So has there been anything along this journey where you feel like you have no idea maybe how it works or how to solve this specific problem, or you said like something wrong with the truck and some people didn't show up? Like, did you have to go to the field yourself and do the work, or what have been there some stories or things you could write the book about or something like this? Because there must be. It just can't be like you have lots of tailwinds and it's all fun.
Oh yeah, no, all the time. I think it's I've said before, as an operator, you either become a stoic or you become insane. Otherwise, you wouldn't. Those are the only two options. No, we've had trucks break down on train tracks, and the calls in the middle of the night, and upset customers, and I think you have to just go in eyes wide open. There's, like you said, there's plenty of war stories we could tell, and I think our GMs even more so. They're the ones that kind of handle everything on the front lines, and then I mean we get the stuff that really escalates. So it's certainly not it's definitely not easy, but I think it's straightforward, and I think that's why I think that I think from kind of the 80s to probably 2015, maybe 2019, kind of pre-COVID, when it came to value creation, the shortage or the limiting factor was capital, and that's why private equity, took off in the way it took off, where there was lots of decent operators, lots of decent businesses at low valuations because there just wasn't enough capital. That has flipped now to where there's an absolute abundance of capital, and the shortage are good companies and good operators, and for good reason. Like it's operating is on a day-to-day basis is difficult. There's plenty of issues that are your responsibility that you have no idea how to solve, and there might not be a solution, and it's still your responsibility to figure out a way to keep the business going. And so I think that's where like I think from the outside, a lot of people think about these high-level strategic things about when I buy this business, what's the right, strategic decision to make? That's not what you're thinking about day to day. Day to day, it's just about how do you keep the trains going? How do you make some money every single day? And if you do that well for, 5 years, then you've probably built a good business, right? So we've started investing in other searchers, and the number one thing we look for is bias to action. You're not going to have all the information. There will not be an obvious right situation, a right decision in the given situation, and so you just have to make a choice. You have to decide which way you're going to go, and then if it was wrong, you have to revise it later. But you're going to have to continue making decisions in the face of uncertainty and just keep the trains rolling and roll with the punches as they come.
Where is DFW Turf Solutions today? Like maybe you can share revenue, how many people, and what is the plan for the next 12 to 36 months? Even though you as well are biased towards action, but you must have some type of plan for the future as well.
Yeah, so we're last year we finished kind of in the low 20s of revenue. Yeah, we're in 7 cities now. We're opening Charlotte right now. That's our kind of next new location. Generally, we're opening about 3 new locations a year, and the goal is to do 1 or 2 acquisitions a year. The acquisitions are a little bit more unpredictable, right? It has to be the right time for the seller. It has to be the right time for the business. But the goal is to build kind of a 50 million revenue company. Get to that point. I think at that level, we've built a company that is truly national. That is has true experts at every level. That has a shared service center where at that point you can start going after any city you want, and it's kind of like a relatively easy plug-in. You don't have to figure out a lot of new states anymore. You might start going after the 1B type markets because you already have something close, and we've really seen that work out a lot. If something's only like an hour and a half away from us, it's a lot easier new location to stand up than something in a new state that you have to fly to. So we're trying to kind of do all the hard ones up front, really get a coverage of the whole US. And I think at that point, we'll kind of reevaluate if we're still the right folks to run the business, or if there's someone that has kind of stepped into that and taking it to the next level, right? Someone that maybe has a new location opening team and can, instead of doing 3 markets a year, they can do 10. Folks that maybe look at vertical and integration and look at the distribution side, the manufacturing side. So we have a very clear kind of to-do list of what we need to do to build a really good install business, a nationwide install business that I think is going to be valuable to a lot of people. And at that point, we'll kind of reassess at who the right person to own the company at that point is.
So what about your own life before and after? Life when you were working for in the private equity and life now? Are you ever going to holidays, or is there any life like a balance, or how has it been?
Yeah, I think it's I think on pure hours worked, you definitely work a lot more in private equity. I think it's way easier. There's just it's a lot of just kind of your brain's running at 50%, and you're putting decks together, you're putting a model together, and a lot of it is just kind of almost like bricklaying type work. I think it was much less exhausting to me to work until midnight or 2 a.m. on the type of private equity work than it is the operating a business day to day, where you're just your brain's running at 100% because every decision you make is meaningful and pivotal. I think the benefit obviously is you definitely get a lot more flexibility, right? If I do something on a Saturday morning or a Sunday night or maybe even a Monday morning, is probably up to me. And so I think you do get more flexibility, but you're thinking about the business effectively 24/7, right? And it's one of those things where the way to describe it is a little bit like you're on call, like a doctor, where if something goes wrong on a Sunday morning and you're not going to deal with it, like you might run into an absolute disaster on Monday. But at the same time, if there's something on Monday evening that doesn't need to be done, you can push it to Tuesday because you can decide it. So I think the flexibility and the control are nice. It's different levels of kind of strain, I would say. And to me, it's great to have the flexibility. It's great to have the stuff that you're working on matters, right? You're never working on a pitch deck or something of a deal that is never going to get done, and you're just like, great, I'm going to spend 6 hours on this on my Friday night, and then on Monday morning I know we're going to kill it at first sight. So it's nice to know that the stuff that you are working on matters, right? Otherwise you wouldn't be working on it. But it is certainly a stressful gig in the sense that the buck stops with you, and it doesn't matter if it was your fault or not. That the truck's on the train tracks. It's your truck, and you got to figure out how to get it off.
Are you happier and more excited than ever now doing what you're doing?
Yeah, I mean, I think it's we've gotten incredibly lucky with the opportunity with the company that we stepped into, the people that are working for us are absolute rock stars, and we're grateful for all of them, and not both culturally and with the work they're doing. So I think there's only so much you can diligence with a business. At the end of the day, it is a leap of faith, and we just got really lucky on the people and kind of the industry that we get to work in, and I think also just lucky on how much of a trend there was. Right, I think if the industry was growing 20% instead of 50, we couldn't sit here and say, oh man, we really underwrote to more. So really kind of caught lightning in a bottle a little bit there. And at the end of the day, it's better to be lucky than smart. So yeah, we're excited about the opportunity. We got in it at the right time, and we're excited to take it to that national level over the next couple of years.
Okay, that's awesome, Johannes. This is the great way how to end. Two quick fire questions to you. What is your favorite book, number one, and number two, best investment advice you've ever received?
So on the book, I mean, obviously I've read all the finance ones, but I'm sure everyone's said those before. I think one that's very applicable to people looking at this kind of decision is called The Happiness of Pursuit, which was one I read when I made the transition from sports to finance. And what it's about is it's various people that had lifelong pursuits, travel each country and all those types of pursuits, and how kind of sobering it was whenever the quest was done. Right, they had seen all the countries, they had seen all the birds in the world, whatever, and how the true value and the enjoyment is the journey itself. And so I experienced something similar for me in track, where when I scored my PR, the high only lasted for like a day or two. And I was like, wait, I thought this was going to be it, right? This is like the eternal bliss. And I think it's a very like human and kind of cultural way to where I think a lot of people think, oh, once I get to this point, I'm going to be happy. Once I get to this, I'm going to be happy. And this is a good book to kind of rewire your perspective towards it's the journey, not the destination, for lack of better description. And I think it's the same for businesses, right? You're going to do this for 5, 6, 7 years. You better like the journey, because if all you're looking for is the exit, it's not going to be worth it. You're going to look back and say this was terrible, right? So you better find something where you're going to enjoy the journey of getting there. Find something hard, find something challenging, and I think that book does a really good job of showing you people that did think at the end of the rainbow, when I complete this quest, I'm going to be happy, and the happiness was along the quest. And then best investment advice is just money. I think the focus on principle is the number one thing that you should be worried about. If you have if you lose 50% of your money, you need to make 100% just to get back to even. That's really hard to do, and so that's the way we run the business. You have to have a lot of upside to justify risking capital and risking your investors' money. And I see folks sometimes just taking a trade where the risk and reward are just off. So you should always focus about not losing money first, and then you can talk about the upside.
Okay, so thanks a lot for doing this. So again, Johannes, thanks a lot for your time, and thanks a lot for your transparency, and very excited to do it again why not in 12 months, to see where you've grown this business.
Yeah, definitely.